I'm going to start this video by telling you that most people that try to beat the stock market fail. And if you're a smart DIY investor, you probably already know that. And you've thought, why would I ever pay someone to manage my money for me when I could just buy an index fund that's already statistically going to be better than anything else they were going to do? And honestly, good job. The people that I come across that have been able to stick to low cost, diversified index funds have done an amazing job. But what if I told you there was a way to actually add extra return and beat the stock market? A way that steps out of the traditional long only world that most investors are stuck in. My name is Samuel Harnish, founder of QFS. I used to work at PIMCO, the firm that pioneered a lot of the strategies that we're about to talk about. And today we're going to focus specifically on something called portable alpha. This is a more nerdy kind of technical video compared to what I usually do. But if you're the kind of person that likes to see data, you're like me, you make decisions based on data, then this is the video that's for you. I'm going to go through all of the relevant data to explain why this is something that I believe actually can work. All right, so let's just get this out of the way from the beginning. A simple Google search should show you that you are correct. The vast majority of active stock pickers, including professional fund managers, fail to beat the market after accounting for fees. And over long periods of time, it's 80 to 90% of them. It's still unbelievable that these things exist. But if you want to make it even worse, none of the data that I see here ever takes into account taxes. So if someone's going to deviate from the market, they probably have higher turnover than an index fund would. So in my opinion, the correct way to evaluate this would be you would need to adjust for taxes and you would need to adjust for risk. If they're running more concentrated portfolios, there's probably more risk. I would say then it's somewhere between, 98, 99% actually underperform when you properly adjust for risk and for taxes. So I am right there with all of you guys at home that say this makes no sense to pay someone to actively manage your stocks. And the other part worth saying is that these stats always leave out, statistically speaking, there's always going to be some percent of managers in that stat that outperform entirely due to chance alone. If we had a bunch of people sit and flip coins, there's going to be some people that they hit heads 5 times in a row. If you have a big enough sample, someone's going to hit heads 10 times in a row. That's just how probabilities work. And so another thing is, it's not enough to just say that some managers can outperform. You have to actually know who they are ex ante, which again, no one does. So according to Google, this is some of the reasons why it's so difficult. There's costs associated with doing it. Markets are really, really efficient, meaning prices are close to what they should be. And then there's psychological biases, which I'm going to get into why that's absolutely true and what we do about that. And then there you go. Even Warren Buffett, the legendary investor, advocates for passive index investing, believing it outperforms most active stock pickers over time. Okay, so you're never going to hear me disagree with anyone that says those things. When people come to me and they have index funds, I say, great job. Like, way to go. You're not doing silly things with your portfolio, trying to pick stocks. You have a ton of concentration in just a few names. I think you're doing a great job if you just own index funds. Now, that's not what we do at QFS. And here we go. I'm going to explain to you why. So this is where we get to something called portable alpha. And this is the book to read if it's something that you really want to learn more about. I always am condensing and simplifying things in my content that I make for people. This book actually unpacks a lot of things that I'm not going to touch on simply because I don't have time. But the general idea is I want to separate my alpha source from my beta source, and I want to pursue alpha in a market or asset class where the ability for active management to produce excess returns is far more robust. So said differently, I want alpha in a place where I can actually make alpha. US large caps is the single hardest place to make alpha. Whether it exists or not is a debate and argument that people will have endlessly. What PIMCO realized was, because they have such an affinity for derivatives and use those before most other firms were using them. If I want to get exposure to a specific investment, I can use a derivative contract that mimics or gives me exposure to that investment that I want. But here's the unique difference. I might only have to use $10 to get $100 worth of exposure. Let's say instead of I want $100 invested in Apple stock, I might be able to use $10 to buy something like a total return swap that gives me exposure to Apple in the amount of $100. That's leverage. I can have $90 cash sitting here, and I only need to use $10 to purchase $100 worth of exposure. Now, this $90 cash, I need it. It's serving as collateral for this derivative position that I hold, but I don't have to just hold it in cash. PIMCO realized, well, wait, we know how to make alpha in short-term bond funds. Why don't we just do that? And so the original concept was actually to create excess returns, even just in bond funds themselves. It was a kind of a sneaky way to free up some more capital to produce some excess returns. There used to be mispricing sometimes between the derivative contracts and the underlying investments, and there might have been opportunities to be using the derivative over the literal cash bond in this example. Now, the evolution of it, what they started doing was no one's beating the stock market. So they said the beta of the stock market, which when we say that, we just mean basically like think of it like an index fund. So the index fund, the equity risk premia is super attractive. It's fairly reliable over long periods of time. And thanks to firms like, Vanguard and BlackRock today, you can own it for almost free. And so why are we messing around with that? Like, let's all just be really honest. It's amazing that you can own the entire world stock market in a single fund, in an ETF today, that's able to defer taxes endlessly. Think of that as your starting point. What if we don't mess with that? We don't try to produce alpha over on that side, but instead we create alpha over here with a short-term bond fund. And so the mechanism that you would do that is, let's say you want to track the S&P 500 for your beta. I don't need $100 for $100 of exposure to the S&P 500. I might only need $10, okay? So over here, I'm going to do $10, but I get $100 worth of exposure. Now I have $90 cash freed up. I'm going to invest that in a short-term bond fund. Now, in reality, there is a financing cost associated with this. So you have to produce a return in excess of your financing rate. And so this is something that kind of hard to DIY because it's really important that you get accretive, attractive financing rates, which I can talk about later in the video. And then it really matters who your counterparty is that's giving you the leverage. I mean, that's another thing that can go wrong with a portable alpha strategy is even if you do everything quote unquote right, and you've got a good beta source and a good alpha source and you're well capitalized and the risk of margin call is really low, if your counterparty, your bank, your custodian, whatever it is that's extending the leverage to you, if something's going on with them, idiosyncratic to them not having to do with you, they can pull the rug on you and blow up your whole strategy. So that was a little bit of a detour, but just saying you have to produce an excess return in your alpha source over your financing cost. Then what you're doing is, hence the name portable alpha, you're porting your alpha source on top of whatever the beta is. This isn't a mystery over here. Like, you're going to get whatever the beta is. If I buy S&P 500 futures, I'm getting S&P 500 return. I'm just going to stack this alpha source. I'm going to port it over on top. And so now what I've done is I've taken a more reliable alpha source, which is the bond market. It's so much easier to outperform fixed income indices than it is stock market indices. And so what you do is you take the alpha that you can generate there and then you stack it on top of your beta. In order to illustrate and try to explain this point better, I'm going to use one of PIMCO's products to explain this a little bit better. I have to be so clear. This is for educational purposes. I am not saying to use this fund. I am not saying not to use this fund. I'm just using it because it's going to be helpful to illustrate the point that I'm trying to explain. So they have their PIMCO Stocks Plus suite. And what we're going to look at right here is their long duration fund. I've been talking about a short-term bond fund allocation, but to really get the point across, I'm going to use this one as an example. So here's what it says: an innovative approach to large cap investing, US stocks with excess return potential, collateralized by an actively managed portfolio of long-term bonds. Now, long-term bonds, that just means a lot of duration, a lot of interest rate sensitivity. So if interest rates fall, you would be stacking the return of the stock market, which in this case here, we're saying the S&P 500 plus whatever excess return over your financing rate the long-term bonds generate. Now, if you guys know, interest rates did nothing but fall post GFC. And so the blue line, this is net of fees. If you had done the stock market plus the long duration bonds, you had a tremendous amount of outperformance over the S&P 500. So when people say you can't beat the S&P 500, it's like, yeah, like stock picking is not going to work. You just got to think outside the box, step outside of the world you've been living in where your only option is to pick stocks. It becomes easier to beat it. Now, the reason why I specifically chose this one is to show you this isn't some magical riskless strategy. Portable alpha is stacking two different return streams that have their own unique risks together It's introducing additional operational complexity, which I can explain that if you reach out and book a call. I'm not going to explain that piece because that'll take forever. If you recall, what happened in 2022? Well, the stock market sold off, but not even close to how much long-term bonds sold off. You know, you were thinking you were great, crushing it, and you're like, wow, like I figured out the secret. It's just you stack long-term bonds on top of the S&P 500 and you win. All of that reversed on you in 2022. As you can see, the blue line plummeting relative to what the green line's doing. And if we look at annual returns, this is where you can see in the run-up, relatively consistent outperformance most years. 2022, you would have been down 43%, while their benchmark, which would have been the S&P 500 is what's being shown here, is down 18%. Okay, so it's not magic. You're just simply stacking two returns. If the thing you're stacking on top of is working, then there's outperformance. So that's an example of a portable alpha strategy. I'm going to get into now the one that is my preference, and that's actually taking a stock market index and then adding a long short, equity market neutral, meaning equally long and equally short, sort of hedge fund allocation as your alpha source. I like that approach for me personally, for QFS clients, for a handful of reasons. And so if you're watching this video and you've seen other videos and so far you're like, hey, this isn't something I've ever heard a financial advisor talk about. Like, what is he even talking about? This is the sophisticated investment stuff that's out there. I mean, this is very normal in institutional investing world. Now, the kinds of things that I'm talking about probably aren't your typical run-of-the-mill financial advisor model portfolio, what they would be doing. I set out to build a firm that was doing things differently, stuff that actually has data supporting it and makes a real value proposition for people where it's, yes, you can do an index fund on your own, and that's amazing. What if there was something that is actually worth the fee that an advisor would charge you in order to enhance what your portfolio is able to do? And this isn't something that I can do with everyone. Currently, we work with families that have at least $5 million in investable assets, but midway through this year, we're going to be upping our stated minimum to $10 million in investable assets. And so if you're interested in the kinds of strategies that I'm talking about and the way that we build portfolios, then I'd encourage you to book a call using the link that's in the description. So now let me tell you about portable alpha using long short investing. And to give that one the proper sort of introduction, I would say this has become my favorite investing book. It does a really, really good job of leading everything with data, not emotions, not feelings, not gut discretionary stock picking, none of that. This is, what does the data tell us? What can we actually count on or rely on? And how do we create robust portfolios? When you were looking at markets in 2021, valuations were so stretched across every asset class, every traditional asset class. And it was like, well, what are you supposed to do about that? How do you build a robust portfolio that can actually meet people's goals? Because at the end of the day, this isn't a game. We're managing portfolios to meet future liabilities, whether that's kids' tuition bills, whether that's funding your own retirement, whether that's some sort of legacy donation to charities or to your kids or grandkids. I mean, it really does matter that you optimize the assets that you have in your portfolio. And because I care so much about trying to show you guys the data of why we do things this way, I even bought the Kindle version of the book just so I could show you this. So we're going to touch on our style premia or factors or alternative risk premia. I mean, it has all of these different names, but outside of just the stock and bond markets, there are these anomalies, let's call them, that have unique risks and return streams of their own. And so some of the most well-known ones would be value, momentum, quality, stuff like that. Value probably more so than any other is the most well-known. So all value is, a very crude definition of it, would be stocks that are cheap compared to stocks that are expensive. And so it would be their stock price relative to some fundamental metric. Earnings is like the one that most people start with. If I sort all of the stocks in the investable universe and I say which stocks would rank in the bottom third in terms of value, which would mean they're the most expensive, really high PE ratios versus the bottom third, really low PE ratios. Those would be the value stocks. If I go long the cheap ones and I go short the expensive ones, what happens? And so this chart right here is how people will usually show that. they've concatenated a handful of different time period data sets so that it goes back all the way to 1826. So when people tell me like, I don't believe in long short investing, it's like, well, I don't know what to tell you. Like we have 200 years of data that this stuff persists and it seems to work. If you look at this middle line, think of that as whatever the market as a whole did. And then it would say, what did the bottom third do relative to that? What did the top third do relative to that? You can see that over time, the bottom third, or in this case, the most expensive stocks, they actually tended to underperform, which is why the line is moving this way down relative to what the market did. It's probably worth pointing out that this is a log scale. These things would get pretty exponential and they would almost look weird. So that's why you have to do them on a log scale. But then if you were looking at the cheap stocks, that would be this line right here. They actually outperform the market. There's an excess return. And then what this top line is showing you, top third minus bottom third. So that's what I was saying is long one, short the other. And so then you're really just getting what's the difference between those two. Well, that's created positive returns over time. And then this green one is them just saying if you adjust and make sure that you're industry neutral in your long shorts, it's actually even better. Now, you'll notice this thing does not go in a straight line up. It's like the stock market in some ways. Your specific factors that you're doing, they have their own tracking error, their own unique volatility. And anyone that's been a value investor has known post GFC value investing has been extremely painful because you had this phenomena of whoever was the most expensive at sometimes is what it felt like. Those were the stocks that would actually outperform, and the cheap stocks, they were lagging. So that's why you could see your long short on the value factor actually has hurt you. I don't think this has been updated past maybe it was like end of 2020, early 2021. Now there's since been a reversal and it's come back. Now's probably a good time to touch on that. So now I want to take a look at AQR's kind of flagship long short mutual fund. And I'm saying it again, this is for educational purposes only. I am not saying to use this fund. I am not saying not to use this fund. Please consult your own financial advisor and figure out what's best for you. It's just going to be really helpful for us for educational purposes is why I'm using it. So if we look at the performance, and they are doing things in here like what we just looked at. That value is one itty bitty piece of what they're doing. They're doing all kinds of different factors and signals that they are long and short. And people ask me, well, yeah, well, does that work? I don't know. Look at this. Here's a long short fund that's annualized at 27.7% over the past 5 years. They've had a great 5-year run. If you look at the 10-year, you're looking at 12 since inception, 13. Okay. Those are solid returns. It's not super correlated to anything else because it's its own unique long short exposure. This one runs with some beta in it, hence why their benchmark is half MSCI World and then half T-bills. So just like, again, you really got to know what it is you're investing in. Not all long short funds are the same. But the reason why I wanted to use this one is because I deal with you guys on both sides. The people that are so skeptical of everything. I get other people that I'm like, I don't think you actually understand the risks of anything that you're talking about or what your buddy said or what you've heard. This stuff isn't without risk. So here's the fact sheet for it. And I pulled that because I wanted to look at calendar year return. So like great since inception, great 10-year, 5-year, 3-year. It's been a great time. If anyone knows AQR, they know it was not a fun time for that 2018 through 2020 period. Compared to their benchmark of half MSCI World and half T-bills, their long short model being used in this fund lagged that benchmark by 13%. And then it lagged it by 13% again. And then it lagged it by 22%. That is huge deviation. That is risk showing up. So when I look at what the data tells us, and there's different ways to look at this. You could just look up how different factors done for certain periods. There are periods of time where value got absolutely crushed. And just to reiterate, that's not the only factor, only thing they're doing in their fund, not even close. But all I'm saying is there's risk here. It's not a smooth, beautiful private credit looking line that just goes up and to the right always. You're gonna have to accept that there are going to be periods of drawdown. It's no different than investing in the stock market. That's the only reason why a return would even exist in the first place. There wouldn't be a return over long periods of time if it weren't for the painful time periods. And that's the only reason why I wanted to bring this one up, is just to make sure I'm explaining the risk to this. So it's kind of like when we looked at the the PIMCO's stocks plus long duration fund, it really matters what your portable alpha source does. Something probably only has alpha if there is some sort of risk that you are taking and it has its own variance around its sort of expected long-term average. And so you got to be willing to commit to these things for the long term. Just like for those that actually stuck things out with AQR, they more than made their money back when a lot of these things reversed. And I think that's another important point to make when you are doing investments that are based on fundamentals, based on data. There is this likelihood that things come back around to you, that rationality is restored to the market. When you are actively picking stocks, that may or may not be the case. Like if the way that you see the world and pick your stocks can be embodied by a specific style, there is cyclicality of styles where they'll fall in and out of favor. But for you guys that are DIYers that reach out to me, I don't see a style in your portfolios. I see momentum, I see tech, I see growth. I see a lot of things that it can go against you for a long time and never come back. It brings me peace knowing that periods of drawdowns that we go through with our investment style, we just got to stick it out because we have 200 years of data supporting some of the things that we're doing. So we know it'll work insofar as technically speaking, all of this is extrapolation. But I just want to say the confidence that people have when they say the stock market will go up, like over time, that's the level of confidence I have in our sort of style premier factors that we're doing. It's, the world can completely change, but I think that's why it's important that you work with a manager that also has their own proprietary signals and factors that they're working on to change with paradigm shifts, I suppose. And while we're on the topic of risk, I think it would be interesting to mention the pairwise correlation of different factors or styles. In this case, we're looking at carry value and momentum across different asset classes. There's such little correlation between them. This is why systematic hedge funds make a lot of sense, is you can combine all of these different return sources. And when you combine them, you create a really attractive risk-adjusted or high Sharpe ratio profile. And in reality, most managers that are any good, worth working with, they'll usually be using actually hundreds of factors or signals. And so what a long-short model might look like is saying, let's rank the stocks based on all of the factors we're going to use. So what you can see with this one is value, momentum, quality, and then proprietary. In reality, that proprietary column, there's probably over 100, depending on which manager you work with, that fall in that proprietary. They're not going to tell anyone. They've found some sort of a signal or factor that works, both in sample when they're back testing and then out of sample when they apply it, and then they'll run it live. So what they do is they rank the stocks. So let's look at stock A versus stock B. They'll go and everyone that knows what they're doing goes sector neutral. And so you're going to have a stock A in consumer staples, a stock B in consumer staples. The stocks are all ranked based on their characteristics for the particular factors or styles. Stock A is scoring a lot of ones, so it's a good stock. That means based on all the parameters here, we like that stock. Stock B, it's got a 5, a 3, a 4, a 5. That's a bad stock. What we want to do is we want to go short the ones that don't look good on all the characteristics and qualities that we like, and then we want to go long the one that does look good. And as you can see, this is a vast oversimplification, but this is what would be going on at the different industry levels and then ultimately at the individual stock levels. And so the goal there is that over time, the relative difference between the stocks that you are long and the stocks that you are short is in your favor. The ones that you're short do worse relative to the ones that you are long. Now, what's cool about this is if it's done in an equity market neutral, meaning equal long and equal short, it has next to no correlation to the stock market. So if we go all the way back to my starting example where I've got stocks here and I got my alpha source that I'm going to port over. Well, having long duration exposure worked really, really great. But then in 2022, the correlation between bonds and stocks went way up. And so your alpha source was down and your beta was down. One of the reasons why I like long short is that the correlation is low to the stock market and it's more stable through time. You don't see the swings and correlations going way up in long short investing as long as it's a sufficiently diversified model. So when you take that and you combine it with your beta source of the stock market, that can create a very, very robust, attractive risk-adjusted return where the volatility pickup that you experience in your portfolio is pretty small relative to now this actual real expected outperformance that we think we can get net of all of the fees. And one other Another point that is interesting and cool about long short investing is the financing rates are extremely attractive and low. So if you are shorting stocks with a good manager that has a good negotiated rate with the custodian or counterparty, you actually get paid something called a short rebate. And so your net financing costs of you can run the leverage up real high is extremely cheap. It's the cheapest form of financing on the planet. And then the very last piece that I tried not to make the centerpiece of this video, I wanted this to just be about the pure investment application, investment approach. The last piece is the potential tax benefit. So in all things portable alpha world, the ability of a long short tax aware implementation to harvest capital losses, that's where things get really, really exciting. So when we go all the way back to 80 to 90% of active stock pickers don't beat their benchmarks, don't beat the market after fees, and that didn't include taxes, so it's really close to zero. This is a strategy where that can actually be the opposite. When you introduce the variable of taxes to how you evaluate the investment strategy, you actually expect tax alpha. You expect additional return, additional value add from the large amount of capital losses that you're able to realize while you're managing the strategy. And so people who say, well, you know, why would I hire an advisor? Well, if an advisor could help me access and understand and size and manage a tax aware long short SMA that's doing, you know, the index that I want. Maybe it's even the ETFs you already own that are low basis, and that's the account. And then we're going to add long and short that can produce an extra return stream that can also tax loss harvest huge amounts of capital losses. I'd sign up for that. So I hope this video wasn't too technical for all of you out there. This is just one strategy out of dozens that we use for folks. And everything that I want to do is bring value to people and investments that are actually worth complexity, because of the value they can deliver. I don't like complexity for complexity's sake, but everything that we're talking about mathematically, it just makes more sense. And so I'm not going to shy away from it because it's more complex or it's more difficult to manage or set up the accounts. I think it's in a lot of people's best interest in terms of their after-tax wealth compounding to be using stuff like this. And so if you're tired of the same kind of cookie cutter 60-40 stuff or just buying index funds, then I'd encourage you to reach out, book a call using the link in the description. I'll take a look at your unique situation, what your tax pain points are and what your goals are. And I'll just be honest with you. If I see an opportunity for us to add value to you in excess of our fee, and it's something I actually think you could benefit from, I'll put together that proposal for you and we can go through it. Thanks for watching this technical video. Please subscribe to the channel if you haven't already, and I'll see you in the next video.